I think the risk to banks and also insurance companies and also pension funds, frankly, will come from commercial real estate.
This is Elijah K. Johnson with Liberty and Finance, and these are the Miles Franklin weekly specials for August 26th through September 2nd, 2024, while supplies last. First, we have the famous 1-ounce gold Krugerrand at just $60 over spot. Next, we have the favorite bullion coin of Europe, backdated silver Philharmonics at just $3.10 over spot. Next, we have compelling pricing on various pre-33 American gold coins. For current pricing on these or any of our other products, call 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Adrian Day from Adrian Day Asset Management. Adrian, thank you so much for joining us today.
Thank you.
Well, it's great to have you today. What I wanted to start off with is kind of your outlook for the economy moving forward as we're, entering the just before the month of September, when the Fed is expected to cut interest rates for the first time. Your perspective on where we're headed now?
Yeah, well, first of all, I think the economy in the US economy is a lot weaker than the headlines would suggest. The headlines, the media and the politicians would suggest. And I think you can see that in a lot of things, but particularly, say, the employment picture. We had that massive new jobs revision number last week by the Bureau of Labor Statistics, where they said they had overestimated new jobs by 818,000. I mean, that's massive. So that kind of puts a dent into the strong labor narrative. And the other thing, frankly, is that you look at this year, pretty much all of the jobs growth this year, net jobs growth, has been either part-time jobs or government jobs. And that's not a healthy economy. So, we could go through all different sectors of the economy, but basically, I think the economy is already weaker than it appears, and the employment in particular, and that's, I think, the employment picture deteriorating is why the Fed decided to, why it appears the Fed will act next month. So that's going to have an impact, obviously. If the Fed starts cutting rates, that's going to have an impact on the economy, but also on all markets. Typically we would expect that when the Fed starts cutting rates, then there will be a period, whatever that period is, a year, 2 years, of rate declines, whether it's every meeting or every second meeting or whatever. But the trend will be to cut. They don't cut, then raise, and cut, then raise. You've got to start really cutting rates meaningfully for it to have an impact on companies and households whose interest rate charges have gone up so much. So typically, when the Fed starts cutting rates like that, it's a sign that we are in or heading towards a recession. And the interesting thing is that is actually a very, very positive environment for gold and gold stocks. Not the recession itself, but the Fed's reaction to recession is very, very positive for gold and gold stocks. Interestingly, it's a lot less positive if you look at history, it's a lot less positive for stock markets. And it makes sense because when the Fed starts cutting rates, it's a sign that the economy is slowing. If the economy is slowing, then even if companies are helped on the interest rate, on the debt side of the equation, they're finding demand for their goods and services goes down. And so we're going to start to see earnings, decline, and that typically is bad for stocks. So I think the period we're heading into will be positive for gold and gold stocks, negative or neutral at best for the equity market. And when I say neutral, I mean it'll be very negative for some stocks, like the long duration unicorn stocks. They will tend to be hurt, and we'll get rotation into more value-oriented stocks, more real stocks with good dividends. And hopefully into commodity stocks.
No, it typically works that way, right? When we see a rate cut, that it's good for gold and commodities. Is that, as you've seen, different rate cuts, is that typically what happens?
No, absolutely it is. Now, of course, the big exception was 1980, but that came after Volcker had absolutely quashed, killed inflation. But yeah, typically, if you look at the last seven rate cycles, when the Fed starts to cut, then that is very, very positive for gold. Other commodities can act differently. If we're in a stagflationary period where we have inflation and a weaker economy, a soft economy, then typically commodities do well across the spectrum. And oil is often actually the leader, outperforming even gold. If you're in a more deflationary environment, then that tends to be much more positive for monetary metals, gold and silver, but much less positive for commodities. So I think an awful lot depends on just how bad the economy gets. Soft growth or zero growth plus inflation for commodities will do very well.
Now, what about gold and silver mining stocks? Because I know if you look at, the indices were down compared to how gold has performed. So it seems like the stocks have underperformed the gold market. Do you think that will change soon? And if so, is it a really good opportunity in the mining stocks right now?
Yes and yes. It already is changing very slowly. I mean, if you look on a 12-month basis, gold has outperformed. If you look on a 6-month basis, more or less the same. I'm just looking right now, and it shows gold up 22.3 and the XAU up 23.5. So basically the same. That's year to date. If you look at 6 months, then the stocks have well outperformed. If you look at 1 month, the stocks have outperformed. So I think and so is silver, by the way. So I think we're beginning to see that turn where the gold stocks and silver outperform physical gold, which is what we normally expect in a gold market. This gold market has been different, of course, because of the source of the demand and why people have been buying gold. So when central banks, as we know, have led the gold market over the last 12 months, 18 months, and central banks are buying physical gold. They're not buying Newmont or Barrick or, let alone junior exploration stocks. And so it makes sense when you think about who's been buying and why they've been buying, it makes sense that gold has gone up more than the stocks. But that is beginning to change. And I think this is a remarkable opportunity, to be honest with you, Elijah, because normally at the beginning of a gold bull market, and go back to 71, 76, 80, 2008, at the beginning of a gold move, the stocks tend to outperform at the beginning dramatically. Once gold bottoms and starts to move, the gold stocks outperform dramatically. So go back to 2000, for example. I think gold was up about 12% in the first 3 months, which isn't bad for an insurance asset. And the gold stocks were up over 50%. So that's the typical sort of, and we saw that in 2008 as well. So I think we have an unusual and very attractive opportunity now to still buy gold stocks before they have had the leverage to the gold price, and while they are still fundamentally inexpensive. And that is something, a lot of people, as Oscar Wilde once said, people know everything about price, but nothing about value. And you look at what the gold stocks have done in the last, 2 months, and you say, oh, I'm not going to chase these stocks. We forget that, first of all, the stocks, just in terms of price, are a lot lower than they were in 2022, let alone 2011 and 2012. But in terms of value, I've given this example before, but you look at Agnico Eagle, for example, which has had a very strong move this year on the back of some very strong quarterly reports. Agnico Eagle is selling at about 8 times cash flow. And if you look back at its history, it has rarely been meaningfully lower than that. So it is selling very, very close to its all-time low in terms of price to cash flow. Barrick, for example, on a price to book net asset, price to net asset, same thing. It's within a couple of percent of its all-time low price to net asset. And when you've got gold making new highs, you expect multiple expansion. You expect the stocks to trade at higher multiples. So no, I think we have a very, very attractive opportunity right now.
And if we do look at the conventional sectors, right, if you look at the stock market or the bond market, it seems like there are signs that things are overvalued or maybe not performing as well as often a lot of people would think. For example, in the stock market, you've mentioned how the Magnificent Seven is not so magnificent anymore. Can you expand on the performance we're seeing right now and what you expect maybe going into the end of the year?
Sure. Well, when you say there's been signs that the stock market is overvalued, I think we've had signs the stock market is overvalued for a while. But of course, things can remain overvalued for a long time, just as they can remain undervalued for a long time. What we've been seeing in the last couple of months, when we had the stock market drop last month, some of the big tech leaders led on the downside. Now they've recovered. But interestingly, if you look at, we're in earnings season now, NVIDIA reported last night. If you look at five out of those seven, the Magnificent Seven, 5 out of those 7 were higher before their earnings and after their earnings, NVIDIA being a prime example. And I think that's a reflection of the fact that maybe people are beginning to realize that some of these stocks are a little overstretched, shall we say. When you drop on earnings, and I mean, if you're an NVIDIA fan, NVIDIA's earnings weren't that bad, right? It's just that it really brings home to you just how overvalued these stocks are. So I suspect we're going to start to see rotation. Again, when interest rates start to come down, typically these long duration companies that don't have earnings or much in the way of earnings in the short term, they will tend to fall faster than, let's say, the value stocks, but are more reasonably valued on a valuation basis. So I think we're going to start to see rotation, out of those high flyers, out of the stocks that have led the market for the last few years, and into the ones that have lagged, like small cap stocks. We'd expect the Russell stocks to perform better, the value stocks, the good dividend payers. Obviously, a company that can pay a good dividend and the dividend is sustainable, if other things being equal, if interest rates decline, then that stock becomes more attractive because the dividend becomes more attractive. And I think we'll also see some rotation into commodity stock. Things have been left behind, like commodity stocks, oil stocks, and hopefully gold stocks.
And what are some of the fundamental reasons then we're seeing this rotation? I know also in your latest quarterly newsletter about 2 months ago, so maybe we could get an update on this. You've also mentioned that there's a rotation out of the U.S. stocks and into more global stocks.
Absolutely. What's driving it is just the fact that the leaders in the U.S., which have been the leaders in the world, are just overvalued and cannot sustain the sort of growth, stock price growth that they've had in the last few years. However great a company NVIDIA might be, however short in supply their whatever demand for their chips there is, the stock simply cannot continue to grow at those kind of rates. And you've got a situation where one stock, NVIDIA, is responsible for 50% of the stock market's growth this year. You've got a situation where 10 stocks represent 75% of the S&P. And then when you look internationally, you find that, this Magnificent Seven represents almost 20% of the world index, and things like that just are unsustainable. NVIDIA is bigger than the German stock market, bigger than the UK stock market. When you start to look at things in comparison one with the other, then I think you start to realize just how out of whack some of the valuation metrics are. So I think when people a change in the economy, such as interest rates coming down, it makes people look at fundamentals a little more. Because as I say, typically when rates come down, stocks like Amazon's a great company, but these long duration stocks where earnings, and particularly the unicorn stocks with no earnings now, they do tend to fall faster. So people are starting to look for, well, what's underperformed for the last few years? And in the US, I mentioned what's undervalued, and in foreign markets have undervalued, but particularly the smaller markets, not necessarily emerging markets, but the smaller markets like Hong Kong, Singapore, Brazil, some of these markets, even though Brazil's done reasonably well, they've lagged, particularly the US stock market and many of the major developed markets.
It's interesting because if you just ask, the man on the street or just your average person investing in the stock market, often, they might express some of the concerns that you're talking about, it being a bit overvalued, but they're going to say, and a conventional investment advisor is probably going to say that, you just hold on for the long run. The stock market makes 7, 8, 9% per year on average. So you'll be fine. So your perspective on that, I know a lot of people in the alternative media alternative investment space have been saying that worked for about 40 years. And now there is actually going to be a fundamental shift in how investments are going to be moving in the future. So your perspective on that long-term outlook?
I'm not sure I would call it, a shift is one way of putting it, but I just think these things move in cycles. And so, you can look back from 1966 when the market peaked. It didn't exceed that peak till 1982. Now, this is not pre-war history or anything, because we could talk about the 1929 crash. But anytime you mention the 1929 crash, people roll their eyes and say, well, that was then, this is now. But 1966, that's when the Beatles came out. So it's relatively recent. 1966 to 1982, before the stock market exceeded that peak. That's a long period of flatness. And typically, and of course, that period, just like 1929, was preceded by a long period of, dramatic growth in stocks and dramatic overvaluation. And when your starting point is a point of overvaluation, right, like 1966, and I believe like 2024, when your starting point is then, your next several years are going to be much, much lower returns for that market to get back to a sort of long-term median of growth. And again, it's cyclical. We've seen periods, in the past 50 years when foreign markets have outperformed the US market. In the 50 years that I've been watching foreign markets, this last 10 years is actually the longest period I can think of when the US has been the leader, and so dramatically the leader for so long. Yes, every quarter, every year, there's one market somewhere that's outperformed the US. But basically, the US has been the strongest stock market in the world among all the major markets for a decade now. And that is an unusual period. Going back, there's been periods when Japan has been the leader, when Europe has been the leader. And the US market may have been a meaningful underperformer. So I think it's all cyclical, and we're just going to go back to that period of foreign markets outperforming the US.
And I think it's very important to understand what you're saying about these cycles as well, because some assets will outperform in some time periods and others in other time periods, and you can make a lot more if you choose those, if you time it correctly, right? If you swap in and out of different sectors.
Yeah, I don't look at it as timing, because timing sort of implies you have a crystal ball and you're making, you've got the inside track on what's going to happen ahead. But I look on it more as looking at what's good value and what's overvalued, what's undervalued. And, if you like, that becomes timing, but not from sort of predicting anything, just looking at valuations. So right now, for example, in my managed accounts, the accounts we've got in the last year or two that are just gold accounts, they're fully invested. And the reason they're fully invested is because I'm finding lots of good value in that sector. The conservative global accounts that come to me are still 50% cash. And it's not because I've made a prediction, oh, I think the stock market's going to fall. It's because I'm not finding sufficient number of good quality companies that are undervalued. So, if that's your prism, then it sort of takes care of itself. You either hold a lot of cash, or you're fully invested, or you're invested in this sector, or you're invested in that sector because of valuations.
No, I guess wrapping up here for the outlook for the economy, if we wanted to get into some of the vulnerabilities in the economy, obviously you say a recession is very likely in the future. We're seeing issues with the job market here in the U.S. A lot of people also are concerned about the banking system, and we saw last year a crisis in the banking system. Do you have any concerns in that respect? And do you think a recession or an economic downturn could have a negative impact on banks and maybe cause further closures?
Well, I certainly have concerns about financial institutions, including banks. A lot of the regional banks, the smaller banks, a lot of insurance companies, pension funds, for example. They will, the banks will be helped by lower interest rates, right? Because it's so I mean, that is not more banking problems is not number one threat that I see if we move into a period of rates coming down. I think the risk to banks and also insurance companies and also pension funds, frankly, will come from commercial real estate, because we all know the commercial real estate market is not doing well. We've all heard the anecdotes about buildings that's, sold for $4 billion 5 years ago, and then was sold, last week for $500 million. We've all heard stories about, new office blocks that have 20% occupancy, etc. But, there's an extend and pretend on valuations. So a bank does not want to foreclose. They certainly don't want to foreclose on a lot of properties. So long as they can keep those things on their books at the value marks that they have, they're happy to do that. There is a point, of course, when you can no longer pretend. When if the lender goes bankrupt, for example, you have to change your marks. If you're in a syndicate and everyone else in the syndicate is marking down, you have to mark down. If you have auditors come around and start saying, I'm not sure about these valuations, you have to change the valuations. And I think that's where we're going to see a big risk a big structural risk in the US economy. You look at, for example, banks and insurance companies. I mentioned syndicates. A lot of these big office buildings are syndicates, and sometimes they're international syndicates. You've had Japanese banks and Japanese insurance companies write off, not down, but write off their loans on certain buildings where the US banks are still valuing those same loans as part of the same syndicate at cost. So someone is wrong. Maybe the Japanese are being too conservative, but also the US banks and the US insurance companies, because the same with the insurance companies, I think are being too optimistic, would be the nice way of putting it. So I think that's definitely a risk. The other risk, of course, with the economy, and everybody knows this, but I think it's worth emphasizing, as the economy starts moving into a recession, let's not forget that the lower 50% of the population in terms of net worth and in terms of income are already really struggling. You know, when the dollar store has sales plunging, that's a really bad sign. Now, you look at Walmart, for example. I think it's important we differentiate. You look at Walmart, and Walmart is doing well, but the CEO on several of the quarterly calls in the last year has said they're noticing an influx of higher income consumers coming into their stores. So, you know, the person that normally shops at Neiman Marcus or Nordstrom might go to Walmart to buy, or Target to buy stuff for their kids. They're not going to go to the dollar store. And so things like Walmart are doing well because of higher income people coming into their stores. Things like McDonald's and the dollar store, which are really focused on lower income consumers, are doing poorly. And we mustn't forget that so 50% of a population already thinks we're in a recession. And when the economy in aggregate moves into a recession, then half of the population is going to be suffering quite severely.
It's definitely some frightful statistics there, and it's important to position ourselves correctly for the time ahead. So we do appreciate you making us more aware today of what is happening in the economy and some of the insights you bring in the investment arena. If people are interested in learning more about your work, where can they find you and what will they find there?
Yeah, well, the website is adrianday.com, one word. And you can either go to my newsletter, I have a newsletter, or go to the money management. But if you go to the money management, we've got or both of them actually, we have a whole slew of interviews, some with you, some with your competitors. So we've got a lot of interviews. We've got some, articles and so on that people can read.
Fantastic. Well, we'll put a link in the description to adriandayassetmanagement.com here so people can check that out. Please do. Highly recommend it. So thank you so much, Adrian, for your time, and you have a great day, and God bless.
And you, Elijah. Thank you very much for having me. Thank you.
This is Elijah K. Johnson with Liberty in Finance, and these are the Miles Franklin weekly specials for August 26th through September 2nd, 2024, while supplies last. First, we have the famous 1-ounce gold Krugerrand at just $60 over spot. Next, we have the favorite bullion coin of Europe, backdated silver Philharmonics at just $3.10 over spot. Next, we have compelling pricing on various pre-33 American gold coins. For current pricing on these or any of our other products, call 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.